Howdy, Jacob here. Today we're looking at Burlington Stores in the specialty retail industry. 15.3 billion market cap on 15.8 billion enterprise value. Currently very high PE, but their margins are a bit depressed from what they were pre-COVID levels. We'll see if they can get back to pre-COVID where they had almost high teens, almost 20%. And even in 2 years, 30% return on invested capital. Very amazing. But right now, they're suppressed to mid single digits. Same with their operating margin. But gross margin, 40%, not bad. And it is higher than 10 years ago. Growth is also fairly impressive. Double growth over the last 10 years. That's a very positive sign. Their increasing in revenue is extraordinarily consistent. Wonder if they're just placing down stores and really, they're doing a great job, clearly. Balance sheet shows 925 million cash on hand, essentially no short-term debt, 1.4 billion long-term debt, and a whole lot of capital leases. Capital leases make sense. I see them at almost every mall I go to. I just went to a mall today, so just saw them today, so no surprise there. 1.4 billion long-term debt. Let's see what that is in relation to free cash flow. Free cash flow, it's kind of all over the place. Maybe 300 million on average, and so it's a little less than 5 times their at 300 million. But I mean, I don't know. The use of cash is just buying back shares, paying down debt, and then reinvesting by making new stores or making the ones that are there better. So, um, yeah, I think if we go forward with about a third, roughly a third of their cash flow going towards debt reduction, should be pretty comfortable after that with the end of 7 years with their debt being pretty minor in relation to free cash flow. Again, not saying it's a concern now, just pointing it out. Revenue growth, I think I would probably be pretty comfortable with 7% growth. Let's do 6%. I don't know if I feel comfortable with 7%, but it's definitely possible. But let's do 6% for now. For margins, let's do 4 across the board. 1% of the shares would be about 150 million to offset stock-based compensation, about 230. That's a hefty amount of their free cash flow. So let's say about 1%. Terminal PE. If they can just keep putting down more stores that are having the same margin as their other stores, you hit the top line, you hit the bottom line, you're good. But it's not necessarily going to be great if they just keep putting down stores. It hits revenue, but they're inefficient stores, meaning that they're paying a lot just to get a little bit of money to the bottom line. That's not what you want. You want to keep creating efficiencies, especially in the retail industry, where you don't just want to keep putting down more. It's not necessarily like a McDonald's or one of those food things, but I do think there's a shopping experience that people enjoy, and I think that Burlington might have some sort of thing there. But again, with these types of margins and this type of return on invested capital and assets, I'm just a little hesitant on it. So I'll probably give them terminal PEs market average. Oof. And we're saying the company's stock price needs to fall 76% before you get the return we're looking for here. I think I'm fine with that. I do think that there's not a whole lot of retail outside of the food industry that is a great business, but I do think that this could be one of them, and I just don't think it's at the right price now that I'm looking for. But I do hope you enjoy the video. Have a great rest of your day. Thank you.